Hello and welcome to the podcast. Today is the first of our magazine format podcasts. We've got three segments up today. First, we're going to look at things in the news. After that, we've got a special guest on. And finally, we've got some questions and answers which Mike and I are both going to answer.
Thanks,
Mike, how are
Andy.
you?
Good, thanks. How are you doing?
Wonderful. Living the dream. Right then, first segment is in the news. So today's news item is titled "The March of the Free Platforms." There's changes afoot amongst the platforms which started out free and very basic. They're all trying to up their game and bolt on functionality. The first one I've got here is Free Trade have already added a SIP, and that includes one of the versions of Drawdown, which is UF Plus, and they've also added a junior ISA to their offering.
That's very interesting. Yeah, I mean, free trade has been the odd one out, hasn't it, for a little while in not offering a SIP so far. But I think the junior ISA is also interesting because not many platforms offer that.
Yes, I think they're the first fully free one. Um, Trading 212 don't yet have a SIP, but they've come out promising that they're going to be adding that shortly. Apparently, that is currently in testing with a limited number of users.
Again, that's another free platform which seems to be gradually adding in all of the various accounts that the big ones used to offer.
Yes. Invest Engine were first to the party with a SIP. They've added Drawdown now, and that's both versions. That's both FAD and UF Plus, but it is via a manual process involving paper forms. So it sounds like they're treading very carefully with that and playing it cautiously. And
Yeah,
they've also said that they hope to add a lifetime ISA, but they haven't yet said a launch date for that.
I agree. It's getting very interesting and it's good to see some competition in the space. I think a lot of people have some suspicions on whether the free platforms will stay free forever. But I think for people in the start of their fire journey and who are building up pensions and ISAs and things, there's no reason not to use a free platform. And then at the time when you start to get into drawdown and you're financially independent, you've always got the option of just switching it to one of the platforms that has more capabilities in drawdown, for example.
Yes, and whilst ever there's a few platforms competing there, that's great for consumer choice.
Yes, I mean, I think the more features that the free platforms add, the more pressure there is on the existing platforms to lower their fees and to try and offer something that makes them at least look a bit more competitive.
Yes, it keeps them all honest. Do you think that's the direction of travel? Do you think they're all coming cheaper and better functioned, or how
I
is it
think
going?
I think it kind of goes in waves. I think at the moment we're in a sort of jostling for position where there are quite a few new platforms, and I don't think all the free ones will survive either in terms of being free or in terms of not being bought out by one of the other ones. I wonder whether some of the free platforms are deliberately positioning themselves as prime candidates for being taken over by one of the other platforms. Whether
Yes, that's
there's some
their exit strategy. Yeah.
Yes, whether their owners are building up a big client base, offering as much as they can, and then the exit strategy is they get bought out by one of the big ones. I can never remember which way it works, but I think is it Invest Engine is owned by what Aberdeen or somebody like that, or
Interactive Investor are part of Aberdeen.
yes, yes. So the ones that have bigger companies behind them, I think, have a better chance of surviving in some form. But it's very tempting for the big company owner to very gently introduce a few fees here and there, or ultimately try and position it as a sort of second rate product within their portfolio and try and get people to shift over to something else that might have more functionality.
I don't think you can choose your platform based on expecting to be there for the whole of your investing life. I think you have to expect to the landscape to change, and you will probably move platform at some stage. But in the meantime, there's no danger, is there? I mean, all of these guys are regulated in this country, and our holdings are protected by the government.
Correct. I think there's no danger. I think there's a bit of a risk that some of them might suffer an IT outage or something like that. But I think those kind of risks aren't really a danger in the accumulation phase. They're only a danger if you're relying on this platform to pay for your groceries
Yes, if it all
when
goes
you're
wrong,
retired.
then you're looking at potentially a few months of while they unravel things, being needing to access your money, and
Yeah,
that
and
might be a hold up.
I think even then, most sensible people would have at least 3 or 6 months of spending somewhere more accessible in either a different platform or just in their bank account to cover that kind of risk. Um,
Very good. Well, that's the news covered. Shall we move on to our special guest next?
yes, we can.
So today, folks, I'm going to be interviewing a high-profile figure from the fire community. He's called Mike Garish. We thought that to start out, we should take turns, and over the next couple of episodes, we will interview each other about our fire story, and just to give you all a bit of background on where we come from and what we're doing here. So, Mike, welcome to the podcast.
Thank you.
So, first question I've got is for you: when did the penny drop about fire or financial independence, however you want
Yeah,
to phrase it?
yes, I can actually remember this one quite well because it was a bit of a sort of penny dropping moment. I was living in London and I had a couple of rental flats and I'd bought a flat and I wanted to move and have my own front door. And I sold the flat to a guy who ran some sort of very early online flat share agency thing. And he was quite transparent and said to me, "Oh, yes, it's a great flat. It's got 3 big rooms. It's got 2 bathrooms. Well, I think 4 rooms. I can't remember, maybe 4 bedrooms." And he said, "I'll put it on my website and I can get this much per month per room." And I said, "Well, hang on a minute. If I could have got that, I could have paid my mortgage and I'd have had enough to live on." And he said, "Yes, exactly. I'm going to get 3 or 4 of these and that's it. I don't need to work ever again." And I thought, why am I not doing this? And I just at that point sold the flat to him and taken out a huge mortgage, well, relatively speaking, on a very small house just inside the M25 to get my own front door. But it kind of stuck with me that you could, it wasn't impossible to take a bit of risk and throw some money around and get into a position where you had enough money coming in that you never needed to work again.
So property investing was your first foray into financial independence, was it?
Yes. And I think that's not uncommon because I think the tangibility of it all makes it much easier. Everyone can see that if you've got, uh, 4 2-bedroom flats and each bedroom is renting out for this much and you've got a mortgage of this much, the maths isn't all that complicated. I mean,
We,
at the same time, obviously you're taking on a huge amount of leverage and you're very exposed to lots of things going wrong. And a lot of property investors sort of conveniently overlook that kind of thing. The interest rates could shoot up, tenants could not pay, and all that kind of thing. But it was
yes.
more the concept of it that occurred to me.
So what was the reality like? I mean, did you have bad tenants? Did you get stung with rate rises on your mortgage or anything like that?
I did have a bad tenant, yes. I had about as bad tenant as you can get, which was someone who just stopped paying. And then it turned out that the guarantor of the tenant had changed the contract that he had written so that it stated he would only be liable for the rent while the tenant was living there. And then there was an enormous legal argument about whether the onus was on him to prove that she wasn't living there or whether the onus was on her to keep paying. and it was a bit of a bun fight. But
This is
yes,
far from passive investing, then, isn't it?
yes, yes. I think most buy-to-let investors have at least one bad story, but usually it's outweighed by pretty good ones. I didn't suffer too badly, luckily, on interest rates. I was kind of lucky to be doing it in a low interest rate period. And for a little while, I was doing it in London, where unless you were very stupid indeed, you couldn't really fail to make money by just buying and selling houses.
So how has your approach morphed over the years? Have you got out of those rental properties and put the capital into global funds, or what have you done?
Yeah, so I got into the contracting game. And I think I was thinking about this. I think the change from being a salaried employee into contracting, as well as the sort of buy-to-let side of it, opened a lot of doors to kind of other ways of making money. It wasn't all about salary. And then with the contracting, I don't know quite how. I think I must have spoken to the right people or found the right people. I heard I heard all these stories in contracting about people um, buying properties with their SIPs and all this kind of thing. And there was a kind of a meme about people, IT contractors buying property in Croatia inside their SIP, and then they'd buy two properties and rent one out to themselves through their SIP, and then let the other one out, and basically pretty much retire instantly. Um, but I realized that that got me onto the whole kind of SIP thing and the pensions thing. And because I had a limited company, I realized pretty quickly that there was this amazing, what looked to me like an amazing kind of um, free lunch where money from your limited company went straight into your SIP without any corporation tax, income tax, or anything.
Yes, it's pretty generous. Comes before national insurance and corporation tax and anything, doesn't it? Really, pension
Yes.
contributions.
I mean, and having a limited company in itself was a bit of a swizz because you could avoid national income, you could avoid national insurance, income tax, and in those days, dividend tax was very low. So you're already kind of doing quite well. And then I found out about the pension thing, and it was like, well, actually, this is such a good deal. Perhaps I don't need to go down the buy-to-let route so much. And I think by that time, buy-to-let was already looking a bit less attractive than it had been.
Hmm. So you were you a focus on actual fire at this point? Had you heard of it, or was this just trying to improve your future?
A bit of both. I mean, I think how was I? I was still kind of, I don't know, 25, 30 years away from getting access to the SIP. And I realized that it would be kind of a while before I got there. But it sort of dawned on me that this thing was available at 55, and that was not that far away. And then I think from that, I then sort of thought, well, I could probably get an ISA together because if I want to retire a bit earlier than that, I'm going to need something else. And then it sort of fell into place that I put a little bit in the ISA, but kept on feeding the SIP. And it was quite complicated. I was lucky to have a good accountant who explained how all this worked and how things like carry forward worked and that kind of thing. Um,
But you happened across the idea of a bridging fund and then a pension for yourself rather than being told it. This
yes,
wasn't the accountant. This was you puzzled it out for yourself.
yeah. No, the accountant was oddly, and I found this quite a lot. The accountant was oddly very averse to suggesting anything, but he was
Yes.
quite good at answering questions. So I would ask questions like, what if I take out this money as salary? What if I put it in an ISA? What if I put it in my SIP? And the answer pretty much always was put everything you possibly can in the SIP. Um, and so therefore I sort of started the ball rolling, and I realized that when I got to the SIP access, which for me was 55, as long as I kept on putting in what I had been putting in, there would probably be enough to live on. And then I realized that, well, hang on a minute, actually, it's doing quite well. I've probably got enough to do it earlier than 55, so I better put some money somewhere else.
Excellent. So you started building your bridge fund. Did you divest yourselves of the buy-to-let properties then?
Not quite. No, I I simplified it all down, and then ended up keeping, I think, one or two of the sort of better performing ones.
Makes sense.
And then we got married. And then yeah, marriage kind of made life a little bit more complicated because my wife had her own flat, so we ended up selling both our houses and buying a new house, keeping hers for a short period as a buy to let. I can't remember why. There was some reason why it was worth doing, but we ended up kind of just keeping one buy to let.
So did you track your progress? Did you have a goal at this point? Had you quantified how much you needed to amass?
Not quite. So there was it took me quite a long while to get my head round the numbers. And I started reading things like Mr. Money Mustache. And I think, like a lot of people, it all seemed too far away at the start. And then, sort of after a little while, I thought, well, it's sort of looking like it might be quite a decent amount of money. And then the sort of, and then a few years later, you think, actually, yes, it's looking quite good now. And it's looking up, and it sort of suddenly became a bit more real.
So it surprised you the progress, the growth that your money was having.
Yes, not at first, but later on. And I think there's a kind of snowball effect where once I could see some progress, then it was more tempting to put more money in. And then the accountant came up with things like the carry forward rule, where you can use unused allowances from previous years. And I think as a contractor, I'd started charging a bit more, and then that meant more went in, and the snowball effect, where more goes in, you see it growing more quickly, and there's more encouragement to start putting more in, and so that all sort of started working quite well.
Interesting. So basically, you got to the point where you were aware of your allowances and trying to max them out each year,
Yes, that was a big part of it. Yeah,
and
a
and
very big part of it.
that drove your investing forward.
Yes, definitely.
So you had a target. Did you figure out when that was going to be, and did you project an end date?
A little bit, yes. I was deliberately not being too precise about it, but I knew that if things went well, I would be somewhere around 55 and probably a couple of years early, um, to get access to it, and I'd have enough to live on.
Okay, so you didn't need much in the bridge fund.
No, I
Did you
can't
over egg that a little bit then?
I can't remember quite how it worked, but I think it when it actually this is not that long ago, but when it came to it, I was tracking our spent expenditure, and I was working out what percentage of a withdrawal rate I would need at that point to support myself. So, for example, at a certain point, I needed something like a 9% withdrawal rate to support myself if I retired on that day from the money I
Fr
had.
from the bridge fund, was
No, no,
that
from the big
overall?
pot.
Oh,
And
right.
then as it got sort of within 5 years of potential retirement, there were other pieces in the puzzle. And I think what happened was, um, I ended up remortgaging the buy to let, and then we moved house as well. So there are these big sort of big big sums of money sloshing around, and partly accidentally, partly by design, I ended up having a reasonably big cash buffer, which was in conjunction with my ISA more than enough to cover the bridge until I could get to the SIP.
Okay. So it's interesting that you were basically monitoring the withdrawal rate falling rather than as much
Towards
the portfolio total growing.
Yeah, towards the end I was. I mean, I used to post every year, I think it was, in the FI UK group, and I'd say, my withdrawal rate this year has gone down to sort of 7%. And
I remember
without
you
giving,
doing this.
yeah, without giving
You
away,
used to anonymize it in a unfathomable fashion. You talked about West Country units, didn't you? You
yes,
related it all to
yes,
this fictional currency, so
yes. So
you
I
could do it
invented a
without giving
fictional
your personal details out.
I invented a fictional currency, which made it much easier to do because the actual numbers didn't matter. All that mattered was how much you had and what the withdrawal rate you needed to live on that money. So yeah, so the withdrawal rate gradually came down, and then at some point the withdrawal rate got to about 4% and slightly below 4%. And I thought, oh, right, I can do it now. I've got enough in the bridge fund, and there's enough in the SIP to support me. And I think in the end, I took another 3 or 6 month roll, even though I didn't really need it, just to kind of
Okay, so a tiny bit of one more year syndrome.
tiny bit, yes. And I think, and then again, the accountant was very useful because I had around just slightly before then, I'd gone through um, business asset disposal relief, where you close down the limited company and you effectively pay 10% tax,
Yeah.
which took a long time to do, but again was a very efficient way of taking out what money was left in the company. And that also, well, that would have gone into the cash pile, but I invested it wisely in a car instead.
Marvelous. So when you pressed the button and retired, then any regrets? Was it a struggle
No,
psychologically?
no. I'd already gone down to 4 days a week, I think, for the last, I can't remember now, for the last 3 or so years. I was lucky to be able to do it once. And then once I'd got to 4 days a week, every contract I got after that, I said, oh, and of course, I'm currently on 4 days a week and I'd like to continue that. And I was lucky to kind of keep it going. And I'd had quite a few breaks. So I'd had quite a few, whatever you want to call them, sabbaticals, deliberate holidays. So 1 month, 2 months, maybe 3 months over the previous years, of not working. And I think those were quite helpful in getting me into the right mindset.
Spells of unemployment then.
Well, yes,
You're
yes.
you're spinning it in the nicest way, so yeah.
Well, some of them were deliberate and some were less deliberate. And it was and some were sort of in the middle somewhere. So a contract would finish and I would ask around and someone would say, no, there's nothing much available. And then someone would say, oh, there's a job coming up and it's coming up in, 4 weeks' time. And I eventually learnt the confidence to say to them, well, actually, I've got some commitments, undefined. Could I start that maybe a month later? And they generally said yes, because these weren't time critical projects.
Oh, I
So,
see. So this suited you to
yes,
lengthen the gaps.
yes. So I engineered an extra gap. So I think on the one level, yes, you've got periods of unemployment, but if you've once you get a role, as long as you've got enough of a cash buffer to keep you going, it's actually sometimes quite a good idea, I found, because I was quite lazy, quite a good idea to extend that holiday and delay the next role.
A mate of mine was a contractor, and he always used to say that self-employment is really self-underemployment. We're not very efficiently utilized.
Yes, I mean it depends on the role you're doing, but I think a lot of roles in project work have a kind of cadence to them where you start them off and you're not doing very much at all for weeks and weeks, and you're gathering a team and you're sort of shuffling around, having meetings, discussing sort of in quite vague terms what you're doing. And then quite quickly you're kind of in the middle of the job, and then suddenly it ramps up and you're kind of working at full tilt. And then there's a kind of, oh, that's all done. And there's a couple of weeks to sort of tidy it up. And then you're unemployed and it all starts again. And it can be quite draining. And having a break between them, is usually quite nice.
So looking back, you've been retired a little bit now. What would you have done differently? Was this all to plan, or should it have been tweaked a little bit?
I don't think I would have done much differently. I was a bit naive when I first started contracting about how I wish I'd known more about the sort of limited company structure and SIPs and that kind of thing when I started. It took me a little while to get up to speed on those. Um,
It's a
Part of
learning
me
curve
wish,
for all of us.
yes, I mean, I think everyone wishes they started 5 years earlier, no matter no matter what you did. And I think at a certain point, part of me, with hindsight, now realizes I could have thrown everything I could at the London property market and retired much, much earlier, like the bloke I met had done. But at the time, I didn't know whether the London property market was going up, down, left, or right, and it looked pretty risky.
Well, I'm glad it's worked out well for you. And you're
Thanks.
enjoying retirement, no regrets. You don't feel the urge to go back and do a little something.
No, not really. No, I do I do some volunteering here and there, and that's plenty to keep me busy. Um, I think one thing I've said to people in our group is that you have to expect a period of decompression, I call it. Um, I think a lot of people don't realize how big a part of their lives work is. And if you take it away very suddenly, it can leave some people a little bit kind of aimless and a bit wobbly.
Yes, I think we all struggle without a bit of a sense of purpose.
Yeah, I think that's something we're going to revisit in a later episode.
Well, that's all very interesting. Thank you for your story, Mike.
Thanks very much. And I'll be doing the same to you soon.
So our final segment, we've got a few minutes left, was Q&A. We've got a couple of questions that have come in. The first one, what allowances are there which I could use up before the end of the financial year? This is quite a timely one.
Yes, I mean, I think it's probably a bit late now because we're kind of heading towards the end of March, but there are still some things you can do. Obviously, there are allowances for ISAs, which you can top up. And
So the
there,
obvious one is the 20,000 ISA allowance that we all
yes,
get.
yeah, I mean, I think the obvious one, although it's not so obvious if you don't know about it, is the pension allowance. So one of the questions that came in was around bonuses and someone saying that they don't know exactly when their bonus is going to be paid, so they don't know which tax year it goes in. But if you've got a bonus or something about to come in, if you can try and get it in before the end of the tax year, then that can help to go into your pension, and you can use up whatever you've got left of your £60,000 a year pension contribution allowance.
Yes, it's the same as the self-employed catch-22 situation we've got that you need to know your earnings during the year in order to max out your pension allowance, and you generally don't know the accounts haven't been done until much later than that normally. So you have
No, I
to sort of
remember,
get management accounts done in order to get a rough steer on where you are.
yes, I remember when I was running a limited company using, I think it was Zero in my case, to try and get a report that would pull that all together for you. So you had a sort of rough idea of a running tally of how much you'd earned and how much would come in and how much you'd paid into your pension. So so at least when it got to March, you knew roughly how much was in the sort of was what the figures were. But you're right, you never really know until the end of the year, do you?
So we've got the pension allowance, we've got the 20,000 SIP allowance. The only other two I can think of outside of those, if you're investing in a general account, you've got a £500 allowance for dividends, which it's hard to have any control of unless you've got your own limited company and you can pay yourself a dividend. And then there's the capital gains allowance of £3,000,
Yes,
which people often try to harvest by
yes.
switching funds.
Yes, I think that's the usual one to do. So I manage a general investment account for a family member, and every year, usually at the start of the year, actually, I harvest the capital gains tax allowance and move some money into the ISA in that way. But if you haven't
Yes.
done it yet, yeah, you've now got time to do it in the next few days.
And then our other question was during this, the current Iran war situation, should I invest immediately or wait? What do you think?
Yeah, it's a good one. That comes up quite regularly. There's a very detailed and well constructed Vanguard article. Um, and yes, obviously they want you to invest because they're an investment company. But it does go into quite a lot of empirical evidence that suggests most of the time you're better off investing, is the simple answer.
Yes, it's difficult at the moment because it feels like we're in the midst of this enthusiasm for AI, which is pushing a lot of stock prices up. And it's hard to know whether that's a realistic boost to their earnings yet, or it's all a bit speculative. Looking at the charts, I looked at the Schiller PE ratio, and it's high, but we've come down from the peak, so it's not as bad as it was. But you've got this conflicting pressure that any time you wait on the sidelines, you're losing out on earnings in those companies.
Yes, and I think we've all seen people saying over the last 2 or 3 years, oh, the America's a bit toppy and it's a bit overpriced and blah blah blah. But if you'd stayed out of the market for the last 2 or 3 years, you'd have missed out on a huge amount of growth. I remember, I mean, we looked at some figures earlier, and the price earnings ratio of the world market of the FTSE All World is 23, which is not low, but it's nowhere near kind of very high territory.
Hmm. So you're quite sanguine. You're happy to be invested. You're not waiting on the sidelines for anything.
Not particularly, no. I don't tend to take too much stock of what's going on. I'm a bit worried about America generally, and I think AI is a lot of hype, although there is some genuine clever stuff in there somewhere.
Well, I think that's covered that one. I think that's it for our agenda for today. The only thing that remains to say really is if you want to catch the next episode, the thing to do is subscribe to the channel, however you're viewing this, and give us a like to tell the algorithm that you like it and you want to see more of our content. Thanks for listening.
Great. Thanks, Andy. Look forward to next time, and I'll be interviewing you.
Wonderful. Look forward to it. Cheers, Mike.
Okay.
See you soon.
Bye for now.